Welcome to the XRP podcast. I'm your host, Andrew, the XRP Maximalist. If you'd like to join me or contribute to the podcast, you can find me on Twitter at XRP Podcast with 2 Ps. This is where you can connect with me directly with suggestions, ideas, or any form of constructive inquiry. This episode of the XRP podcast is featuring Chapter 2 of the report on central bank digital currencies from the United Kingdom's House of Lords and Committee of Economic Affairs. Chapter 2 delves into how a central bank digital currency would be able to benefit households and businesses, and the problems that would be solved through the implementation of a central bank digital currency on a retail scale. If it is your first time listening, I would recommend beginning from Chapter 1, which features an introduction that provides a summary and basic understanding of the terminology, technology, and context involved in the House of Lords report. This audio series is organized so that the listener may listen to different chapters in any order they wish. This is so the information may be consumed in more palpable, bite-sized chunks. Without further ado, please enjoy Chapter 2. Chapter 2: Households and Businesses. Consumers and Innovation. Under the Bank of England's proposed central bank digital currency, or CBDC, model, the bank would not provide direct CBDC accounts to customers. Instead, it would operate the core digital infrastructure to enable central bank digital currency payments, while commercial banks and other financial service providers would connect this to infrastructure to provide central bank digital currency wallets and related services. The bank's March 2020 discussion paper said that this model could encourage innovation and enable the private sector to create services that support greater choice for consumers. Most witnesses were skeptical that a United Kingdom central bank digital currency payment system would provide significant advantages to consumers over the existing payment system. Patrick Hanohan, a former governor at the Bank of Ireland, said that the benefit of a central bank digital currency to United Kingdom customers at the present would be absolutely nothing, because the United Kingdom already has a reasonably efficient payment system. Just having a central bank digital currency does not give you an advantage, according to Mr. Hanahan. Professor Eswar Prasad, Senior Professor of Trade Policy and Professor of Economics at Cornell University in New York, agreed that the UK has an effective payment system and said that there was not a strong consumer case for introducing a central bank digital currency. One could still make the user case in terms of instability, but in terms of access and efficient low-cost payments, the case is perhaps much weaker in the UK than it is even in the US. Jorge El-Hidri, Group Executive and Co-CEO of Global Banking and Markets at HSBC, made a similar point. Some of the benefits immediately available to a consumer were marginal, but HSBC was considering whether additional innovation spurred by central bank digital currencies could leapfrog existing payment services. Currently, when consumers pay for goods or services with a card, the merchant pays a fee, which can be as much as 2 to 3% of the transaction. Depending on several factors, including the size of the merchant's business and the type of card used to pay, debit card payments, which would likely resemble a central bank digital currency payment the most, have fees that are typically much lower than credit card fees. Andrew Cregan, head of financial policy at the British Retail Consortium, said a widely used central bank digital currency has the potential to increase competition in the retail payments sector, which could reduce the fees charged by the existing payment operators. Other witnesses agreed on the potential for a CBDC to foster private sector innovation. David Birch, an advisor and commentator on digital financial services, said that this was the best single reason for introducing a CBDC. And the Atlantic Council said that a CBDC could help level the playing field for new market entrants. Innovate Finance thought CBDCs would help the UK to develop world-leading expertise. We also heard a CBDC could help increase the overall resilience of the payment system, which was another potential advantage set out by the Bank of England. David Birch said a CBDC should be constructed as a parallel system to the existing payment system, so that the overall resilience increased. That said, we heard there is already significant innovation taking place in payments. For example, the growing use of payment apps is increasing competition with the major payments networks, as they can link directly to bank accounts rather than physical cards. Charlotte Hogg, CEO of Visa Europe, told us that the United Kingdom is one of the most competitive payments markets globally, and that this trend has accelerated in recent years. Jorge El-Hidri said a great deal of work had been done by the public and private sectors to improve the domestic payment systems, but nevertheless, a CBDC could provide a step change. In its March 2020 discussion paper, the Bank of England set out several initiatives that are ongoing to improve payments, including open banking and PSD2, which require banks and other payment service providers to share customer financial transactional data with authorized third parties with the customer's consent. This is designed to increase competition in the banking sector and to enable third parties to be able to innovate and create new financial products. Next, Pay.UK's new payments architecture, which will replace the existing interbank retail payment systems with infrastructure that supports instant settlement with a view to ending multiple day clearing cycles. It should provide some new capabilities that payment service providers can use to benefit customers. Next, real-time gross settlement, also known as RTGS renewal, which will see the Bank of England as an operator of the sterling RTGS service. Promote innovation in payments by renewing the existing real-time gross settlement system and expand access to settlement in central bank money. In 2017, the bank announced that electric money issuers and payment institutions authorized by the Financial Conduct Authority could start applying for RTGS settlement accounts. John Glenn, Member of Parliament, the Economic Secretary to the Treasury, told us that the government recognized that the UK payment system was already effective, but wished to assess the additional benefits a central bank digital currency might provide. Sir John Cunliffe, Deputy Governor for Financial Stability at the Bank of England, said the use case for consumers and merchants should be taken together, as it becomes more difficult for merchants to refuse digital payments by accepting cash only. The question is whether they should have an alternative that anchors the cost floor. Andrew Bailey, Governor of the Bank of England, told us that the increasing competitiveness of the payments infrastructure is a long-standing challenge that requires further work, but his view was that issuing a central bank digital currency was a disproportionate response to that issue. A central bank digital currency system has a potential to spur innovation and greater competition in payments, in addition to those that are already taking place, which may reduce card fees paid by merchants. However, we heard few other significant advantages for UK consumers. We recommend that the Joint Task Force include a greater number of representative consumer groups on its engagement forum to help it identify whether a central bank digital currency would provide any benefits to individuals and households. We heard the United Kingdom's existing domestic payment system is secure and efficient, and it continues to foster innovation and the expansion of services. Many central banks are concerned by the decline in the use of central bank money, also known as physical banknotes, by the public. The Bank of England said banknotes provide an anchor of confidence in the banking system, as households and businesses know they can convert bank deposits to central bank money and that this provides financial stability. The bank is exploring whether CBDCs could improve the availability of central bank money and address the consequences of declining cash use. While the number of notes in circulation has continued to rise in the United Kingdom, most payments that were made in cash are now made in commercial bank money, including via debit and credit cards, as set out in Figure 1. The trend is likely to have accelerated in 2020 because of the COVID-19 pandemic, when cash use fell by 35% compared to the previous year. Richard Brown, Chief Technology Officer of R3, an enterprise technology company, has said that policymakers had an obligation to decide whether a digital form of cash should be introduced if cash use declined to nothing, as cash provides people the ability to transact with one another without recourse to any other authority and with high levels of privacy. Some witnesses were skeptical that central bank digital currencies would satisfy the demand for cash. Andrew Cregan, head of finance policy at British Retail Consortium, did not think a CBDC was in any way a substitute for cash. Andrew Cregan was quoted saying, "I do not envisage that individuals who have been so reticent over using card payments over the years will jump on the CBDC bandwagon and abandon cash. People use cash either for budgetary purposes or for concerns around security or fraud. They use cash for other reasons which will not be affected by the creation of a central bank digital currency." Other witnesses said central bank digital currencies could not provide the same level of privacy as cash. Stephen Bonner, Executive Director, Regulatory Futures and Innovation at the Information Commissioner's Office, said a central bank digital currency would not be like cash, and that proportionate rules on privacy and data protection would be needed. We explored the implications of a central bank digital currency for privacy in the next chapter. United Kingdom Finance said further analysis was needed to determine the benefit of a central bank digital currency, as the public already has access to risk-free money in the form of cash and guaranteed commercial bank money through the Financial Services Compensation Scheme, and National Savings and Investment, also known as NS&I, provides consumers with access to Her Majesty's Treasury-backed savings products. The Bank of England has recognized that a central bank digital currency would be an imperfect substitute for cash. Its March 2020 discussion paper said, "For those in society who value the physical nature of cash, the introduction of central bank digital currencies is unlikely to affect their payment behavior. And so we consider that central bank digital currencies would likely act as a complement to cash rather than a substitute." Sir John Cunliffe said that, from a central bank perspective, cash plays an important role in anchoring confidence in the monetary system, as people can convert commercial bank money into central bank money on demand. John Glenn, Member of Parliament, told us the government had committed to legislate for the continued issuance of cash. Cash continues to be widely accepted in the United Kingdom. If this were to change, it is not obvious that the properties of central bank digital currencies would satisfy any residual demand for cash. which is often valued for the physical properties and the privacy that it can provide. We note that the Central Bank of England has said that it will continue to issue cash on demand and that a public need for money without default risk is covered for most savers by the availability of cash and deposit protection. We also note a core aim of prudential regulation is to ensure that we have a stable banking system. This, together with the deposit guarantee scheme, should ensure that the confidence in the monetary system is anchored. The Bank of England said that cash provides an important role in financial inclusion, particularly for groups in society without bank accounts. The bank's March 2020 discussion paper said that if cash use continued to decline, there is no guarantee that the current private sector provision of the retail payment systems may meet all the needs of all users, leaving underbanked groups of society particularly at risk. It said the following: a well-designed central bank digital currency may also help to boost financial inclusion by being accessible to a broader range of people, potentially in different formats than private sector solutions. According to figures cited by the government in its latest financial inclusion report, the number of unbanked adults in the United Kingdom declined steadily from 2.85 million in 2005 to 2006 to just below 1 million in 2018 to 2019. The number of adults living in households without access to a relevant account fell to a record low of just under 500,000. The legal requirement for large banks to offer customers a basic bank account has probably played a role in this reduction. EY, a consultancy, told us that people in G20 countries are most likely to be excluded from the financial system because they are unable to meet the identification requirements for bank accounts. It's said that digital challenger banks in the UK and in the European Union had been successful, not because they are blockchain-based, but because they enable more efficient customer onboarding and better customer experience. Natasha D. Tehran, member of the Financial Services Consumer Panel, said many of the non-bank alternatives to bank accounts, such as prepaid debit cards, were comparatively expensive. She thought a central bank digital currency could lay a framework through the provision of simple, affordable, non-bank alternatives that could be provided to households and individuals without bank accounts. She said that while a central bank digital currency is not a prerequisite for such services, it is likely that this functionality would be a feature of any central bank digital currency that the Bank of England designed. David Birch said increasing financial inclusion is an important goal as people trapped in the cash economy paid the highest prices for certain services and were left vulnerable to theft. However, he thought it was not clear that CBDCs were the answer to these particular problems. Barry Eichengreen agreed that people without bank accounts paid the most for utilities and other services, but said the argument that CBDCs would solve this problem was specious. He explained that the unbanked paid more because credit providers saw possession of a bank account as a signal of financial stability and reliability. But a central bank digital currency that would be available to everyone unconditionally would not signal anything. We heard that the digital nature of any CBDC would likely prove to be a barrier for some people who are excluded from the financial system. Natasha D. Tehran told us that the increasingly digital nature of the economy meant that people who are not digitally literate need a simple means of making payments, and it was not clear whether CBDCs would fulfill that role. We also heard that reliance on comparatively expensive digital devices could be exclusionary. Professor Daryl Duffy, Adams, distinguished professor of management and professor of finance at Stanford University, thought it was possible that CBDCs could be obtained through physical payment cards, which might mitigate the necessity to use digital services to access accounts. However, he said that realizing the potential for financial inclusion from CBDCs was not guaranteed. In March 2017, the House of Lords Select Committee on Financial Exclusion set out ways that the government could increase access to financial services. It concluded that an increasing emphasis on technology in banking might exacerbate financial exclusion. Digital exclusion is likely to have a particularly significant impact on those who are already most at risk of financial exclusion. In April 2021, the House of Lords Liaison Committee followed up this work and found that certain groups continued to be financially excluded because of increasing digitalization and reliance on mobile banking services. Should cash acceptance decline significantly, a CBDC could be a way to ensure greater financial inclusion, in that it would provide access to digital payment services that are like bank accounts. However, for some, not having a bank account is a choice, and for others, the technological requirements for central bank digital currency transactions may exclude them from accessing it. It is likely there are more straightforward and targeted ways to support access to financial services than to launch a central bank digital currency. Cross-border payments are expected to total to $250 trillion by 2027. In addition to high-value international wholesale markets, cross-border payments are increasingly important to small businesses and individuals alike. In 2020, remittance flows to low and middle-income countries reached $540 billion. The Bank of England's March 2020 discussion paper said that for many users, cross-border payments are expensive, slow, and opaque, and that central bank digital currencies may offer a more efficient way to provide cross-border payments if national central bank digital currency systems could be connected. Jana McIntosh, Managing Director for Payments and Innovation at UK Finance, told us that CBDCs could make cross-border payments cheaper and faster, and could provide the data that would make transactions more secure. Andrew Cregan said that there is a significant scope for the reduction in friction of cross-border payments through new digital money and central bank digital currencies. Other witnesses said improvements to cross-border transactions represented the best use case for central bank digital currencies. Professor Duffy thought improving cross-border payments is the greatest promise offered by CBDCs. Patrick Canohan said the ability to make cross-border payments more quickly and cheaply would be an advantage. We heard technological innovation was already improving cross-border payment systems. Charlotte Hogg, CEO of Visa Europe, said competition was driving cost reductions and that new forms of digital remittances were increasing efficiency and savings. Professor Duffy told us that some banks in the United States were working with fintech companies to use new technologies to improve cross-border payments. On November 22nd, 2021, Victoria Cleland, Executive Director of Banking, Payments and Innovation at the Bank of England, delivered a speech on progress made at the G20 level on making cross-border payments more efficient. The targets include increasing the speed of transactions so that 75% of payments are to be settled within an hour, and ensuring that the global average cost of retail payments is no more than 1%, and the global average cost of sending a $200 remittance is no more than 3%. Barry Eichengreen told us that the barriers to making national central bank digital currencies interoperable were formidable. The two central banks would have to agree on an architecture for their corridor. They will have to jointly govern its operation. They will have to license and regulate dealers holding inventories of currencies and depository receipts to ensure that the exchange rate inside the corridor doesn't diverge significantly from that outside. They will have to agree on who provides emergency liquidity against what collateral in the event of a serious order imbalance. He said in a world where there could be several central bank digital currencies circulating at once, arrangements of this type would require scores of bilateral agreements, considerably more elaborate than those of the World Trade Organization or the International Monetary Fund. Simon Gleason expressed doubt that central banks would allow their own central bank digital currency to circulate widely in the international system in the short or medium term by saying the following: I would find it impossible to imagine that the Bank of England encouraging widespread circulation of it outside the UK simply because of the risk of fairly wild swings in demand externally would create a degree of monetary instability. That would pose a severe threat if your central bank digital currency itself starts being used internationally. That presents a problem for you. John Glenn, Member of Parliament, the Economic Secretary to the Treasury, agreed that bilateral agreements to enable cross-border CBDCs would be incredibly complicated. He added, I imagine that it would be very difficult to establish a global payment system very easily, given the different ways that the central bank digital currencies may evolve in different jurisdictions. The Bank of England has been working to improve cross-border payments, and Sir John Cunliffe told us that the Committee on Payments and Market Infrastructures, CPMI, is leading the work on interoperability in central bank digital currencies. The CPMI, Committee on Payments and Market Infrastructures, is currently exploring what standards and alignments which may be necessary to ease the different types of interoperability which might improve cross-border payment systems. However, some jurisdictions might not want to make it completely frictionless to move out of one currency and into another due to the risk of capital flight or financial instability. Cross-border payments can be expensive and slow. Central bank digital currency systems could, in theory, bypass some of those existing frictions in the international payment system with lower costs. Nevertheless, a central bank digital currency system would still have to comply with oversight frameworks, national laws, and international technical standards, which are a long way from being agreed upon. Cross-border payments are already improving as a result of innovation and competition in the fintech sector. A lot of international collaboration is underway in both the private and public sectors, including at the G7 and G20 levels, to further improve cross-border payments, which will make them more efficient with or without central bank digital currencies. End of chapter 2. Thank you for listening to the XRP podcast. I'm your host, Andrew, the XRP Maximalist. If you'd like to join me or contribute to the podcast, you can find me on Twitter at XRP Podcast with 2 Ps. This was chapter 2 of the UK's House of Lords' third report of session 2021 to 2022. Join me next time where we will read chapter 3 of the report. If you'd like to read the report for yourself, you may find it in the description below. Join me next time in chapter 3, where we will discuss central bank digital currencies and the monetary system. As always, this is made with love, for and by the XRP community. Thank you and take care.